In just over 5 weeks, a new tax law comes into force that will permanently change how Australia's wealthiest superannuation holders are taxed. It's called Division 296. And if your super balance is above $3 million, or if you're building toward that threshold, what you do before July 1st could save you tens of thousands of dollars every single year. Let's get into exactly what this is, who it hits, why it's so controversial, and the precise moves smart Australians are making right now. Division 296 is a new 15% additional tax on superannuation earnings that apply to balances above $3 million. Currently, money inside super is taxed at a concessional 15% in the accumulation phase. Division 296 adds another 15% on top, meaning the effective tax on super earnings above the $3 million threshold jumps to 30%. 30%, the same marginal rate as someone earning a standard middle-income salary. The entire appeal of the superannuation system, the low tax rate designed to incentivize long-term retirement savings, is being dismantled at the top end. Now, you might be thinking that only affects the ultra-rich, but here's where it gets complicated. The $3 million threshold is not indexed to inflation. That means every year, as superannuation balances grow through contributions and compounding, more and more Australians will cross that line. What affects roughly 80,000 people today will affect hundreds of thousands within a decade. If you're 35 right now, contributing aggressively and running a self-managed super fund, you could hit $3 million by retirement, and this tax will apply to you in full. But here's the part that has financial advisors and SMSF trustees absolutely furious. Division 296 taxes unrealized capital gains. Let that sink in. Under this legislation, if your self-managed super fund holds property, unlisted assets, or any investment that increases in value, but you haven't sold it, you can still be taxed on that paper gain. You could face a real cash tax bill on money you've never actually received. This is a structural break from every foundational principle of Australian tax law. Capital gains tax in Australia has always been triggered by a disposal event. You sell, you pay. Division 296 throws that rule out the window. An SMSF trustee holding commercial property worth $4 million could face a tax bill purely because the property's assessed value increased on paper during the financial year. They would then need to find cash from somewhere, selling other assets, taking personal contributions just to pay the ATO. This is a liquidity trap, and it's real. The ATO has confirmed it will assess Division 296 liability annually, based on a member's total superannuation balance at June 30th. If your balance crosses $3 million at year-end, you'll receive an assessment. You'll have 84 days to pay, or you can elect to have funds released from your superannuation account directly to cover the liability. So what should you do? If your super balance is approaching or above $3 million, here are the 5 key actions to review with your financial advisor before July 1st. First, assess whether it makes sense to withdraw the excess and hold investments outside of super. Above $3 million, the tax advantages of the system begin to erode. With Division 296 pushing super earnings tax to 30% on that portion, some investments held in a family trust, a company structure, or personally may yield better after-tax outcomes, depending on your individual situation. Second, review your self-managed super fund's asset mix. Illiquid assets, property, private equity, unlisted shares create the biggest liquidity problem under Division 296. You want enough liquid assets inside your fund to cover potential tax obligations without being forced into a distressed sale. Third, consider pension phase strategies. If you've already retired, moving super into an account-based pension removes those assets from the accumulation phase, and Division 296 only applies to accumulation balances. There are transfer balance cap limits to navigate, currently capped at $1.9 million, but this is a critical planning move for those who are eligible. Fourth, Review spouse contribution splitting and contribution strategies. If you're building wealth as a couple, maximizing contributions to a lower balance spouse's account keeps both balances below the $3 million threshold for longer. Concessional contribution, splitting, and spousal contributions are legitimate, effective tools, and the window to use them strategically before July 1st is closing. Fifth, and this is critical, do not panic and overreact. Pulling money out of super purely based on fear could cost you far more in lost tax benefits on balances below $3 million. Division 296 is a precision tax on excess super. It is not an attack on the system as a whole. Strategic restructuring is smart. Knee-jerk withdrawal is expensive. Now, there's a legal dimension here that you need to be aware of, but cannot rely on. There are active legal challenges in progress. SMSF advocacy groups, industry associations, and financial bodies have raised serious constitutional concerns, particularly around taxing unrealized gains, which may constitute a form of property acquisition without just terms. The outcome of those challenges is genuinely uncertain. Do not wait for a legal miracle before making a decision. Plan as though Division 296 takes full effect on July 1st, because right now, it does. If the legislation is overturned or amended, you can reassess. But if it stands and you've done nothing, the consequences are immediate and compounding. The broader context matters too. Division 296 is part of a wider shift in Australian policy towards superannuation as a retirement income vehicle rather than a vehicle for intergenerational wealth transfer. The government's position is that the tax concessions were never designed to fund estates and trusts at scale. Whether you agree or not, the direction is clear. The era of unlimited, lightly taxed superaccumulation is ending. That changes how you should think about your overall wealth structure. Super remains a powerful tool for the first $3 million. Below that line, the 15% tax rate, the capital gains discount, and the pension phase tax exemption make it unambiguously superior to most alternatives. But beyond $3 million, the calculus is now different. You need a layered wealth structure, super to the optimized threshold, and a complementary mix of trusts, companies, direct investment, and property outside super to carry the rest. The Australians who act now, reviewing their balance, restructuring their assets, and running their numbers with a qualified SMSF advisor before June 30th, will be in a fundamentally stronger position than those who discover the consequences in their first ATO assessment. This is not a drill. The clock is running. The date is fixed. Make the call. If you found this video valuable, don't forget to like and subscribe. It helps the channel reach more like-minded people. And feel free to drop your thoughts or questions in the comments below.